Ryan Brome, COO of investments with Forum Investment Group. And just for some maybe backstory on who Forum is, we're a private real estate manager based out of Denver, Colorado. We've got about 70 employees, and we primarily focus on the multifamily space. We do it through kind of a debt vehicle as well as sort of an equity focused strategy. But the firm's been around 20 years, and so kind of from a market perspective, we're primarily kind of investing in the multifamily space. So obviously see a lot through our debt business. We tend to be pretty opportunistic kind of on the equity side of our business. Yeah, I mean, I think everybody's been sort of looking at the market thinking that things were going to kind of unlock here, in 26. That really obviously hasn't been the case. I think one of the sort of changes or kind of unforeseen circumstances is the Iran war and what that did to kind of the 10-year treasury. And so that's probably created the most volatility in the market. What we are seeing right now is, from kind of the standpoint of assets, I think you've got great kind of high quality, well located assets that have kind of good in place cash flow. Those are actually trading, and you're seeing kind of a lot of bid, for those types of properties. Where you see the biggest challenge or the biggest spread in terms of, kind of asking price and kind of bid price is the markets where there's a ton of concessions. Because I think a lot of people don't really know how to underwrite those concessions and how long they're going to stay in place. So, take Phoenix, Arizona as an example. You've got 12 weeks of concessions in the market. Is that going to stay for the next 6, 12 months? How is that going to be impacted by future supply? And so, I think a lot of kind of people like us, we're being very selective. We tend to be probably a bit more focused on kind of the markets that weren't as overbuilt, such as kind of the Midwest and those types of locations. But yeah, I think everybody is being pretty patient right now, just because if you are a seller and you don't have to sell, you're probably waiting another year. And that's where, again, the whole sort of debt side of the business has come in, where, a lot of these developers do have access to other forms of capital, and they're not necessarily in kind of a forced seller situation. So it's one of those ones where I think you've got to be pretty selective, but we do kind of look at the fundamentals, and kind of the back half of this year seems like it's continuing to kind of improve, just in terms of kind of operating fundamentals. Yeah, I mean, I think we're definitely in the camp that rates are probably higher for longer. I think with just even just the comments from kind of worse recently, I mean, it sounds like there's actually a potential for rate increases, which, 6 months ago, nobody was talking about. So, we've really kind of positioned ourselves to be the beneficiary of it from a kind of a lender perspective. So rates stay higher longer. I think that's good for kind of the debt side of our business. We also think that probably presents more opportunity on the equity side, just because with higher rates, it puts kind of more challenges on kind of developers, owners from a refinance perspective. And so I do think that kind of higher rate environment is going to probably stress more folks' portfolios, which again, there kind of creates probably some more of that opportunity. From an acquisition perspective, though, I mean, when we kind of look at the equity market, we would say, debt's actually not really beneficial right now. And that's why you've seen, I think, going back to kind of your first question, this challenge on kind of the bid-ask spread. So, if you're financing a new acquisition right now, your cost of debt's probably higher than where your in-place cap rate is. And that presents a challenge for anybody. So you have to really fundamentally kind of believe in the market, believe in the rent growth, so that, within kind of 2 to 3 years, you get to kind of that level of positive leverage. So I think it's kind of twofold, right? It's the debt side of the business will sort of benefit. There's continued demand for kind of more borrowings, and then I think on the equity side, I think it's going to probably create more more stress for owners and operators that are potentially underwater. Yeah, I mean, there's always the discussion around kind of household formation and jobs. I mean, jobs ends up being kind of the most important factor that we pay attention to. It's like where are these sort of locations in the country where companies are hiring and people are moving. The cost of living factor is also really important though, just because again, if somebody can't move to a new location for a job and actually afford to live there, that's a key component. One of the things that we've actually seen kind of over the last almost kind of 3.5 to 4 years, though, is that wage increases have continued to kind of outpace rent growth. And so when you actually look at it from a renter perspective, renters are really pretty healthy. The numbers that have actually come back down to kind of the low 20% in terms of rent to income ratios, which we frankly haven't seen in quite some time. So single family still remain very, very expensive, out of reach for a lot of folks, but the multi side is actually becoming kind of just a more affordable option for a lot of people. So, it's a long-winded way of saying that we're primarily focused on kind of, lower supply markets, high job growth markets, which right now the story is around the Midwest. I mean, you're seeing just kind of better kind of supply demand fundamentals in the Midwest. You didn't have the overbuilding, and it is that same factor of, people are moving to places where they can actually afford to live. Yeah, I think the most challenging part around kind of borrowing today is that leverage has really pulled out of the system. So if you think about kind of the two primary, lenders to the multifamily space, it's really, Fannie Mae, Freddie Mac. With where interest rates are today, their leverage levels are way down. They're effectively, if they're kind of quoting a refinance or either a new acquisition, I mean, they're coming in at that sort of 50 to 55% range. So borrowers just have a significant gap just to kind of get back to par. So what you've seen is you've seen more structured solutions. So a lot of folks are now using kind of preferred equity or mezzanine type financing just to get to kind of 65%, loan to values. So that has absolutely kind of become, more prominent in the business. And then you're also now starting to see kind of alternative lenders like the private debt funds, offer kind of whole loan solutions that are shorter term. So a lot of borrowers today right now are looking at kind of more sort of 3-year type solutions because, everybody sort of sees that in 3 years, the multifamily space is going to be stronger. You're going to see kind of positive NOI growth. So there's a lot of fewer people right now that are taking kind of long-term money just given kind of where the market is. And so I think most folks are saying, yeah, I'm going to borrow 3, 4, maybe 5 years with the opportunity to refinance kind of at a better kind of market environment. So it seems like that's probably kind of the take. If things change kind of from a 10-year perspective, maybe the traditional financing markets become a little bit more robust. But right now it's pretty impressive how much is available by way of private credit, which 10 years ago that sort of space didn't really exist for kind of the multifamily space.